Hello everybody, this is Coach D with TackleTrading.com, here to make a quick little video to show you an idea on how you can speculate on a stock using call options if we think the price is going to rise. And so I was on the halftime report earlier today with Coach Matt and Coach Tim, and they did an awesome job and they put out a couple of ideas for us. And one of the things we talked about was oil, the U.S. oil fund and some of the other oil trading instruments. And I think we got a really interesting opportunity here. Now, what the general premise here is the price of oil has gone down. It's gone on sale. And I have reason to believe that the price is going to go back up because the price has come down to the bottom of the trending channel and it tends to go out to the top of the trading channel. And so the idea is when it gets down to the bottom of the channel, you buy. And when you get out to the top of the channel, you look to sell. And it's just that simple. There's an old resistance support ceiling in here that we think could be a buy zone. So for all measures, I think we're in a buy zone on oil. Now, there's no guarantee the price of oil goes up, but I'm willing to speculate with limited risk. And so we're going to look at what it means to buy a call option, which would give us the right to the stock that we can exercise anytime between now and the expiration date. And I think it's going to take it a couple weeks, maybe a month or more to climb up, and we'll see, I'm going to buy more time than I need. And so as a general rule, we like to always take controlled risk trades. And so I'm going to look at the options chain for the U.S. oil fund. And I'm looking here, and we got lots of choices. And as a general rule, when you buy options, you buy more time than you need. Always buy 3 months or more on average. That's a simple rule. So that means I can come out and buy these October options that expire 93 days from now. So that'll give me over 3 months of time. And we get to choose our strike price. And I got a couple of really simple rules to follow. Buy in the money options with the delta higher than 60. Buy in the money options with the delta higher than the 60. So here's the options chain. Here's the delta. The little blue line there, that's where the money is. So in the money's higher than that. So there's the 0.66 delta. So what that means is there's a 0.66% probability that it's going to expire in the money. And I believe prices are going to rise. And so that would give us the right to buy USO at $13.50. Now, my intention is going to be to sell those options once the prices rise, but it's a really simple transaction we can go put. I can say, okay, well, let's go buy a $13.50 call. Right now, they cost $1.10. So my risk would be $1.10 per share times 100 shares per contract, which means my risk is 110 bucks. I can buy more than one share if I bought 2 contracts. That means that I would have a risk of 220 bucks. And you can have just that simple measure of risk right there. Don't buy more than you're willing to lose on. But we can also use a stop loss. And so I'm going to show you a really quick and simple way to set a stop loss and how to estimate that. I think that we got the chance that the price is going to rise from here at 14.10. If it goes below the strike price at $13.50, I think we were wrong about the price rising. So if the prices, instead of going up, go down below $13.50, and I have the right to buy it at $13.50, well, it wouldn't make sense for me to exercise that right if the going rate was 13. So if it goes below the strike price, we're out. And what that means is that the price would have to drop from $14.10 down to $13.50, and by my math, that's 60 cents. And the delta on the option was 0.66. So that means that if it drops 60 cents, I would feel about 66% of that. And so we could take that contract and say, okay, we're talking about a 60-cent drop. I can just multiply the amount it would drop by 6.66 and get a rough ballpark. So 60-cent drop, so 0.60, times a delta of 0.66. Multiply it by the delta times 0.66. That means we'd be taking about a 39, call it a 40-cent hit on the option. And so if I bought it at $1.10 and we were to then put in a stop loss on it, that means we'd put a stop loss on it down at about 70 cents or so. And so I'm going to go ahead and just analyze the risk on that, just on a single contract. And the general idea is, hey, the stock price rises up to where I think it can go out here. I think it can go out towards 1550. We stand to make about 100 bucks. And that would be pretty darn close to a 100% ROI. But if it drops below 1350, that means we are going to stand to lose about at least 40 cents or so per contract. And we could put in a stop loss down at 0.70 or so. And we'll kind of fine tune this as we go, but that's the idea. So I could say, okay, well, I'm willing to risk 40 cents a contract, and if I had I don't know, say a $200 pain threshold, that means I could buy a few contracts. I could buy, 4 or maybe even 5 contracts. And I can go create an order for that, where I'm going to create an opposite stop loss. So I'm going to do a first trigger sequential order. I'm going to create a stop loss, create opposite order, and I'm going to set that down to stop out if it dips below about 70 cents. Now, I just did a rough ballpark, and that means that their estimate would be about $13.52, and so it means I'm probably going to shave a few more pennies off of that. That little calculator did the math a different way and gave us a similar ballpark, but if I go about 65 cents, that means I have about 45 cents risk, or $45 risk, times 5 contracts. And so I'd say, okay, well, if I'm risking about $45 per contract times 5 contracts, that means I've got $225 risk. Well, if my threshold was only $200 risk tolerance, well, I'm doing too many contracts. I'm going to go ahead and drop that down to 4 contracts. Okay, so I got a stop loss at 65 cents, an order to buy it at $1.10. I now have a fixed risk of under $200. Again, just kind of rough math here. We got $45 risk times 4 contracts, which means we're not going to risk more than $180. And if we are right and the prices rise, let's make sure we got that the same. There we go. I'm going to make those good till canceled and then go ahead and send that in. Shouldn't take us too long to get filled. Just like that, boom, we own that contract good through October. If it rises out to $15.50 or so, we stand to make around $400 plus in exchange for about $180 of risk, and that is better than a 2-to-1 risk-reward ratio. And we're talking about a potential 200% return on the risk margin, but we are tying up. We did spend the whole amount on those contracts. I hope you found this video helpful. Come over and join us at tackletrading.com. We got a 15-day free trial for you, and we'd love to see you in our clubhouse. We'll see you there.